All right, so today we're going to talk a little bit about real estate investing, also talk a little bit about the current market, and discuss what the difference is between a real estate fund and a syndication. Sometimes you'll hear those different words thrown about when people are looking at real estate investing, especially right now. There's a lot of discussion over which is better, a syndication, a fund. So I'm going to share my screen. And a few things that we're going to go over. So what exactly are the different types? Syndication versus a fund, what are they? What are the main differences? What are the reasons that you should use one or the other? Which one should I use if you're looking to do a potential deal? So what is a syndication? So syndication is essentially just an offering to bring in investors for a real estate deal. So it's typically an investment in a single asset, one project, and essentially you're pooling cash from your investors to go acquire and maybe upgrade a property and then turn around and sell it at some point, or refinance it out to cash out your investors. It's usually led by a sponsor. Sometimes they're called a GP, manager, whatever the name is. It's the person who puts the deal together. They find the project, they manage the asset, they come up with a team that's going to take care of everything. They go out and raise the capital to close on the deal. As an investor, you know the specifics of the exact asset that you're investing in. So that gives investors some control. Okay, well, this is a syndication for a certain multifamily property on Main Street in downtown of a certain city. So they know exactly the property they're investing in, and they can see all the specifics of the property, how it's been performing. They can even go look at it themselves. So the investor has a lot of control over what specifically they're investing in because the syndication is limited just to that one asset. There's usually set returns, fees, and a payout timeline. Depending on what the sponsor's time frame is, it could be 3 years from now, I'm going to refinance any loan and pay out the cash investors, or they could be looking to sell it in 5 years or flip it in 1 year. And there are certain fees that you're normally told ahead of time what will be taken out. Here's a sample of sort of a structure of a typical real estate syndication. So you have the property, and basically it's owned by a company, which becomes the borrower on a loan. That's the syndicate entity. That's where people invest. The investors, depending on how it's structured, this could be an LLC or a limited partnership, typically. And your investor members would be something like a Class A member of an LLC, or they would be limited partner or LP owners of this entity right here. Then it would also be partially owned by a manager or general partner entity, which would usually be another LLC. They might own a certain percentage and get a return. Maybe it's a 20%, and the investors get the other 80%. And then this management entity is usually owned by the people who put the deal together, the sponsors. That's kind of a typical structure. There can be a lot of variations, but that's just a very easy breakdown. So what are funds? Funds are basically the same thing. They invest in multiple assets. They pool cash for investors, and then they go find assets to invest in. So instead of finding one project, they're looking for multiple. It could be 2, 5, 6, 10, whatever the fund is set up for. It's also led by a sponsor who puts the fund together, goes out and finds the deals, manages those assets and the funds that are coming in. Now, the difference is they're putting their money into multiple assets, and the sponsor is the one who decides basically where the money is getting invested. Most of the time, they're considered a blind pool closed-end fund, meaning they last for a certain period of time only. Maybe it's 7 years. The investments are taken in the first 1 or 2 years. They put the money in, and then maybe they sell off by 5 to 7 years. And it's a blind pool because you're putting your money in as an investor, but you really don't know exactly what your money is going to go into. The fund might disclose that they're investing in multifamily properties in a certain geographic region, and they have certain criteria that they're going to follow. But beyond that, the investor doesn't have any say in where the money is invested. They are basically supposed to trust the person leading the deal, the sponsor, to decide where to put the assets or where to put the cash. Basically, the investor provides a commitment towards future projects. So an investor may not put all their money up front. They might say, I commit to putting in $1 million towards your 5 projects in this fund. And over a period of maybe 18-month investment period or commitment period, the capital calls will be made as projects are identified. And hey, I need another 200,000. 3 months later, hey, I need another 200,000 or 500,000, up to the $1 million that they've committed to invest in these different projects. So the capital is not always invested right away. It could take, 12 months, 18 months, 24 months to actually invest the capital to where it would start earning a potential return. It does also have set fees and returns and a payout timeline, which needs to be disclosed to investors. But there sometimes can be added fees and a longer payout timeline. Just depends on how it's structured. So there could be an asset management fee at the fund level, and then also down on the property level, there could be another fee. So there could actually be overlapping fees in some cases. And it also takes longer to invest the capital, typically 6 months to 2 years. So you won't start seeing a return on your capital for a certain period of time. It's not an immediate investment. Typically, most funds are set up that way in real estate. It's a little bit more complex setup and compliance-wise for the person who's setting up the sponsor. Not super overly complicated, but it's because it's very similar to an offering in a syndication, which you can see by the org chart. Essentially, it's pretty similar. There's just multiple properties. They might be owned by a special purpose entity, an LLC that owns the property, and then the fund itself owns each of the LLCs 100%. So investors put their money into the fund goes out and acquires property 1 through an LLC, property 2 through an LLC. That's the common structure. Then the investors are down here, similar, with a management or general partner over here. Sometimes there's other entities in here for an investment management entity or more complex structures, but this is just a very basic one. So some of the key differences between a syndication and a fund. In terms of risk, a fund is diversified. The capital is diversified among multiple assets, so it's reduced risk to your investors. You've got capital invested into maybe 5 projects, so a lower return on one might be offset by a higher return on another. Versus a syndication, they're just investing in one asset. So if that asset, something happens, it doesn't perform, they could be completely out of luck. In terms of speed, a fund is a lot quicker to execute on for new opportunities, and it's a larger pool of assets that's essentially ready to deploy. A lot quicker than a syndication. You have to identify the property, then you go out and start trying to raise money. And on most purchase agreements for real estate, you have limited period of time to close, whether it's 30 days, 60 days, 90 days. And so you've got to go out and raise your capital quickly so you can close in time. Yeah, the syndication, it's a completely separate capital raise. And also in terms of disclosure, typically if there's a PPM, private placement memorandum, which we recommend, it's going to talk more about disclosure about the property, so your investors know exactly the specifics of the property they're investing in, maybe existing returns, the occupancy rate, all kinds of things that you would disclose in a syndication that take more time to put together. In terms of control, in a fund, the investors have little to no control over the investments. It's a blind pool. They put their money in within, real estate, whatever the fund's purpose is, that's where their money goes. They don't really have any control over when they get their money back. The sponsor controls pretty much everything in the process, when the returns are paid out, assets, or when cash is invested, and when it's sold. Syndication, investors have a little bit more control because basically they can pick which syndications they want to invest in by property. I like that property, I'll invest in that syndication over there. So they have a little bit more control. And when you're investing in just one asset, usually there's a very set timeline of, okay, in 5 years, we plan to sell this or refinance in 3 years. So they pretty much know in general, time frame when they'll get their money out. In terms of costs, the funds are a little bit higher setup costs because there's a little bit more complexity to it from a legal perspective. Sometimes there can be fees that overlap. If there's fees on the fund level, plus they're charging fees on the underlying level for each project, sometimes that can increase the amount of fees paid and reduce the return of investors. There's a little bit more administration in a fund because you've got more entities involved to administer the fund. Most smaller funds don't have to worry about things like audited financials and some other things that you might have to worry about in certain types of funds, but in some cases there is that additional administrative time and cost. And similarly on a syndication, it's very project specific and set in terms of what the costs are going to be. So how do you decide which one is best for you? These are basically 4 factors that I say people should look at. Market speed. How quickly do you need to execute on your assets? In a market right now, it's November 2022. With rates and everything else going on in the economy, usually you need to move pretty quickly on assets and have capital available when you have identified a property so that you don't have to go out and try to raise capital when you find a property. Everyone's competing real estate, and once they find good properties that are good deals, they want to be able to execute on them quickly. So in that case, a fund is going to be better because you're going to have access to that capital, a larger pool of capital, and go in and execute and show that you're able to actually pursue and execute on the deal. Setup costs. A fund has a little bit more upfront setup costs, so it is a little bit more expensive, although not typically a lot more, maybe 20% on the setup costs versus a syndication, because a syndication is still a full securities offering, typically under 506B or 506C. So you do have compliance issues, securities perspective, and setting up the entire structure for it. What are your investor needs? How quickly do they need their capital returned or invested? If they need their capital invested immediately and they want to start earning a return, maybe it's a preferred return, as soon as their capital is invested, a syndication might be better for them. And how much control do they want and how much risk? If they're not willing to take on a lot of risk, a fund might be better for them. If they want a lot of control, then a syndication might be a little bit better. And what's your strategy? If you're a sponsor, general partner putting a deal together, can you actually pursue and operate multiple projects at the same time? If you're a smaller owner-operator, you may not have the capacity to be pursuing and finding a bunch of new deals. You can only take one on at a time. In that case, a fund doesn't make any sense. You should just stick with the syndication and do it per project. If you're able to scale and pursue multiple projects, then a fund can be a better way to go. So these are some of the basics of the difference between funds and syndications. And if you have any further questions, feel free to contact us at any time. My contact info is right here. Thank you.